Hi, this is George. In this video, we are going to see about monthly Nifty Strangle with adjustments. Before getting into the video, please do subscribe to this channel and join our Telegram channel for instant updates. And please like the video if you genuinely like it. Let's get into the strategy. So, this is the first strategy an option seller starts with, basically because it is a very low risk strategy. So for the beginners who doesn't know what is Strangle, Strangle is nothing but selling for OTM call and put. Say suppose if market is around 18,000, we will be selling say 500 or 1,000 points away from the strike price. Say we will be selling 17,000 put and 19,000 call. That is called Strangle. In the strategy, in this example, I have explained about, I have back tested on both like last 15 months of Nifty Strangles, the strategy that I'm going to apply here so that you can see the results. And if you like it, you can start implementing for your own purpose. This is in the strategy, we'll be having only very few adjustments. In general, Strangles will have very few adjustments comparing to other strategies because the break even or width of the strategy where the profitable zone will be more. So in general, there will be very few adjustments. In this strategy, we'll be having furthermore very few adjustments only. So this is very much suitable for working professions and part-time traders. Disclaimer, this is only for education purpose. Please do your own research before taking any trade. This is not a recommendation, but just my view. Let's get into the core of the strategy. So let's say when we are going to enter the strategy. So we are going to enter the strategy by like selling for naked OTM call and put where we get ₹50 as the premium. So I'll just show you with an example. And as because we are selling a naked option here, usually in our strategies we do protected strategies. That is like if we are selling a call option, we'll be buying a put option little further away so that it will be protected. But Strangle by itself will have a long break even width, so we tend to take a naked OTM call and put. And as because we are taking naked options here, so we'll be booking a strict stop loss with if it goes against our view of 10,000 loss. So we have to definitely book a loss of, if we see our MTM to be at 10,000 rupees loss, we will book it. So when we enter second or third Thursday of the previous month for the current month. Let me make it very clear with an example. Say suppose there are, if we want to do for January, we'll be entering in the month of December. So in December, we can see like there are totally 5 Thursdays. So in this, we are going to like start the trade on third Thursday, which is 16th of December for the January end. That is 27th of January. Similarly, for the month of February, there are 4 Thursdays in January. So we are entering at the second Thursday and exiting on the 24th of February, which is the expiry day of that month. So say suppose if there are 5 Thursdays, we are entering on third Thursday of the previous month. If there are 4 Thursdays, we are entering in the second Thursday of the previous month for the current expiries. Exiting is like on the expiry day of that day. If our strategy is like if you have not hit the stop loss, we'll be closing only at the last day at 3 p.m. Let's get into the adjustment rules. So once we entered, we are entering also at 3 p.m. of the Thursdays of the last month, and every day we are going to see the market only at 3 p.m. and only at that time how the market is and where the premium is. With that we are going to do adjustments. If not, we are not going to do any adjustments. So when we are going to do adjustment is if we see like if our premium has doubled on either side. Say we are told like we are entering with a premium of ₹50. So if the premium doubles, at least if it goes to 100, it may be 100 or 150 or 180 or whatever it is, that time we are going to do our adjustment. Only then we are going to do adjustment. And what is the adjustment? Say suppose we have sold 18,000 call at ₹50. Now that 18,000 call has went to ₹100. So now what we are going to do is we are going to book loss in that leg. So in this example, I have given us 110 rupees. So that 18,000 call that we sold at ₹50 has become 110. So we are going to book that 110 rupees. That is, we are buying back that at 110, and we are going to sell 2 quantities of ₹55 each where we are getting. Say suppose the 18,000 call was at 110 now. Maybe we are booking that and we are selling two calls of 55 rupees. Maybe we will get somewhere around 18,400 call option 55 rupees. We will be selling two quantities of 18,400 for 55 rupees to match the premium of 110. So 2 into 55 will become 110. So ideally we'll have the same 110 rupees premium in our trade. So we'll be continuing with the same payoff graph. Now, once after selling this two times of 55 rupees, now if the market reverses and if this 55 goes below 30, say suppose now we have 18,400 as we saw in the last, 18,400 is trading at 55 rupees. Now market has reversed into us, it is going bearish. So this 55 will go down. If it goes below 30, now market reverses and 18,400 went to 25 rupees. That time what we will do is like we will book profit in that and we'll be selling one quantity of 50 rupees. So here it was 25 into 2, which is 50. We'll be selling only one quantity of 50. So 18,400 call was at 25. Now maybe we will be buying 18,200 or 1800 for 50 rupees. The reason why we are doing this is because, say suppose if again market reverses, if we are having two lots, then if it is going in the against our favor, then the loss will also be more. Wherein if you are having one lot, the loss will be relatively less. So always let's have maximum of two lots on a side. Let's not have more than two lots. Say suppose if after doing like 55 rupees, if it still goes to 100 rupees, 110 rupees, then we will not do further adjustment by booking the like a losing leg and maybe selling 3 into whatever premium it is. We'll not do that way. The only reason is because if we do that, the probability of loss will be more and our MTM of 10,000 rupees loss will be touching easily. So we won't be doing that. I'll just explain these with a few examples so that you can have a more clearer picture. So this is the backtested result of the last 15 months I have done. You can see like out of the 15 months, 12 months were profit, and in that 12 months, so the probability of profit is like around 80%. Overall profit is 40,000 and average profit is 2,700. Let's see like maybe the first case of Jan 21 of last year. So let me show you with an Opstra application. So I have put this initially like in the month of December 2020 we had 5 Thursdays, so we are entering at third Thursday. 28th of January we are going to exit and we are going to start our trade at 3 p.m. So in this is the strike. So we are going to see where we are going to get 50 rupees premium. You can see the strike price is 13,750 almost, and we are getting our put option at 12,600. We are selling one lot at 50 rupees, and call option we are selling 14,700. So here only you can see the range is so wide, 12,500 to 14,800 will be profitable between like 2,300 points in that 45 days time frame. So by starting only we will have an upper edge of market generally doesn't go that wide, so we'll be in profitable and max profit will be 7,000 somewhere around that, 7,500. Let's see how it goes as days goes by. I have also given in this like a number of adjustments made. You can see like we have not made more than 4 adjustments in any of the month. And when I say 4 adjustments also, it is not exactly 4, it will be like set of 2. In the previous slide we saw like these 2 or the one set actually, because say suppose if market goes one side and we are going to like close that and sell twice the quantity, and if market reverses and if we are going to buy back and sell one quantity, these two are considered as two adjustment, but ideally it is one set. So you can see like maximum we are doing only, this is actually 2 sets, this is one set, so maximum is 2 sets of adjustments only we are doing. Let's see with a live example here. So we are starting with 50 rupees each and we'll see how it goes. Okay, so the second day of we entered the trade only, we are seeing the market has went in the upside and downside, and because of that our PE has a premium of more than 100 rupees. So as per the rules we are going to close this at whatever the price it is trading, which is 141 in this case. We are closing at 141, and as per the rules, we will be selling 2 lots of put option where we get 70 rupees premium. So here in this case, okay, 75 rupees, which is more or less closer to 70. We are selling 2 lots of that. Now we have these two as the current positions. Let's see how it goes. Market is actually reversing, so it has come down. Let's keep going. Now it has went below 30 rupees, which is 26. So again, in this case, what we are going to do is we are going to close this at 26, and 26 into 2, which is 52 rupees. We are, instead of 2 quantities, we are going to make it into 1 that is selling at 52 rupees. So 52, maybe 49 will take, which is closer, 1 lot. So initially we had this 1 lot which was 12,600. Now, as because this was reaching the like more than 100, it has more than doubled, so we cut that and we split it into 2 and we made it into 75 into 2. And once it goes below 30, we'll make that 2 into 1 by selling that at 26 and selling 1 as 26 into 2, which is 52. We didn't get somewhere around 52, so we got at 49. So this is the first adjustment. Actually 2 adjustments are made, which is 1 set of adjustment. Now the active position is with 1 lot each, we are having 14,700 call and 12,600 put. Payoff graph is still, we have a very big wide range, so we have nothing to panic. Let's see how it goes. Now we see like a call option is spiking. Maybe in call option it might go to 100. If so, then we'll have to do adjustment, or else till then we need not do anything. So yes, call side it has it. So it is 131. So as per rules, we are going to close this at 131, and we are going to sell 2 into 65. 131 divided by 2 is 65, 66. So wherever we get say around 66 in call option, maybe 68, we are going to sell twice the quantity. Now these two are the active positions. Market is still going in the upside, but our MTM is still not reached 10,000, so we don't have to worry. Now it's slowly declining. It is declining. Okay, now it has become 23. So let's book it as per the rule, which is below 30. So we are closing at 23, and now we are going to 23 into 2, 46. Wherever we get 46 premium, we are going to sell as 1 quantity. So we'll just keep going. Even though the market spikes, we are safe now. We are almost ending the month. So yes, we are done. It's 28th January. We are closing at 8,500 odd profit. So this is how, with only 4 adjustments or 2 sets of adjustment, we can make profit in Strangle. Let's take one more example where we absolutely needed no adjustment. Maybe for the month of November we will see. So that absolutely does not need any adjustment at all. So for November, we'll be doing the month of October 2nd week, which is 14th of October, and November month end, and November month end at 3 p.m. So 50 rupees is the premium. We didn't get at 50, so 52 is fine. Similarly for call side, we're getting at 48, that is also fine. Now let's see how it goes. So actually this is a month where we didn't need to do any adjustment. You can see 43 and 76 here. This has never went to 100 on any of the day, and finally these two has decayed and became 0. So we got the entire profit without doing any adjustment. Absolutely no adjustments. 25th of March, 5,000 profit we got. So in this we can see like 1, 2, 3, 4, 5 out of the 15 months, 5 months absolutely needed no adjustments, and others also like only 1 or 2 sets of adjustments. And for few 3 months were in loss. This is like only when we started it was loss, so let me not go to that. And February month we know that the crisis of Russian-Ukraine war came, so because of that obviously it was a trending month, so that is also gone. March month, after doing 4 adjustments we went at loss. Maybe I can explain that to show how the loss came here. So that is the last month. So for February, for March we'll be taking February second week, and March expiry it is March expiry. We'll start at 3 p.m. So 50 rupees. Okay, we are getting at 51 put side, and call side again we are getting at 47 or 48. This is fine. So this again in the second day only the put side has went so below, so it is at 162. So we have to close it as per our rules. So we are closing at 162. So 162 divided by 2 is 81. So we'll search for somewhere around 80, 81 to sell 2 quantities. Actually we didn't get somewhere around 80, 82. So we are going to sell 2 lots of 65, and maybe like it is like 65 into 2 is like only 130, but here it is 160. So we need more 30 premium to match the premium. So maybe we can close this 23 and we can sell somewhere around 50, so that totally the premium will get matched. If you didn't understand, I'll repeat the same. Say suppose here it is 162 plus 23, which is total of 180. So we need the total of 180 as the selling premium. So we search for it, but because of due to liquidity issues, we didn't get some 80 rupees premium in put side. So what we got is 65. So we sold it twice. So we got 130 rupees premium there in the put side. And so if we need like 180, we need somewhere around 50 rupees premium on the call side as well. So we closed that call option there and we bought it. We bought back that sold call for 23 and we sold a new call option for 56 rupees. Now the setup is like for 180 rupees. So we can continue from here. Now this is going to, this is not declined more less than 30, so we'll just wait. Okay, without even going up or without even going below 30, it has went to 160. We already have 2 lots, so and our MTM of 10,000 is reached, so we are going to just exit the trade. So that is how we exited the trade on March. And the reason, because of 24th March is the day when the Russian-Ukraine war actually happened. Because of that, the market was so trending and we ended up in loss. So we are booking loss. So in this we can see like this is a low risk and low return strategy. So comparing to maybe the other strategy on expiry strategy or the strangle strategy, the return on investment will be low, but definitely it's a low risk strategy for, so any beginner can start with this, and once they are little confident, then they can go to straddle and they can go to some other complicated strategies. And in this strategy, the last 2 months you can see like they were in loss, and that is because like of the global situation. Other than that, overall if you see, it is like almost 12 weeks profit, and I can just show you the raw data as well. So this is for the 15 months. If you see the last calendar year of Jan to December, the profit was around 58,616, and this month, as we have only 1 month of profit, it is minus 17,000. So maybe in the next upcoming months, if the next 9 months were good, then again we'll be ending up in profit. And anyway, but these returns are like very much better than FD, and you're not going to do much on this. You're just going to see market for hardly some time. So for a starter, I will say you can start with this strategy, and maybe slowly you can go to some other complicated strategy for making more money. In the next video, we will see some other good strategy and what will be the adjustment for that. Thank you. Please do support us by subscribing to this channel.